Do stock and commodity super cycles, technical analysis, proprietary trading strategies, live mentoring, and an active community of traders excite you? Are you looking for proven trade alerts complete with portfolio allocation, entry price, target, and protective stop levels? Find out why thetechnicaltraders.com is the best source for active traders and investors to learn and earn. Visit www.thetechnicaltraders.com today. Welcome to the Technical Traders Podcast, the show that brings you technically proven strategies and trade ideas from experts around the world. We're going to help you make more money with less risk so you can take your trading to the next level. Now, here's your host, Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome to the Technical Traders Podcast.
Jim, thanks for having me.
Tim, before we get into the interview, can you tell us a little bit about Cycles News and Views?
Well, Cycles News and Views is, I don't call it a newsletter, it's a research letter to try to help people gain insight and an understanding to the market through the use of cycles. And cycles is really nothing more than trend quantification. And then you wrap some statistics around it, and it gives you, you can develop statistical expectations. And then I also use kind of in the background a broader perspective with Dow Theory.
So, Tim, how did you get into trading or investing?
Well, that's an interesting story. I haven't thought about it in a long, long time until you're making me go back. But I guess it all started in college. I took it was actually I don't remember the name of the class, but I remember it was a senior 400 level economics class or finance class, and man, it was fundamentals of analysis, I think, or something to that effect. And I remember we were deriving equations, and this professor, he's writing on the board, and we're doing all this math and all this stuff, and there was one chapter on technical analysis. And when he, we're doing all this stuff, and I realize that I see the philosophy, I'm exposed to the philosophy of technical analysis, that it's all discounted in price, and it made sense to me. And so from there, it became, self-study. I bought some of Pring's books and John Murphy's books and Bob Prechter's material and Peter Eliades. And back in the day, you had FNN was on TV when you had real analysis on TV, and actually we got it on a satellite back in the day. And Peter Eliades was on there, Bob Prechter, and then Richard Russell. I got into Dow Theory, and Richard Russell actually helped me obtain some of the original old writings from Robert Ray, and Robert Ray, he was like, I think he and William Peter Hamilton put Dow Theory on the map. Dow never wrote a book. He died in 1902. William Peter Hamilton worked for Dow, and he wrote one book and some articles and stuff, and then Robert Ray worked for him in the 30s, and he was the leading Dow Theory person during the 1930s, and Robert Ray wrote a lot of material. And anyway, Russell helped me get that. I had a relationship with him, and it's kind of cool. It's like reading the Dead Sea Scrolls or something, original old technical analysis, and I was able to put things together and see how cycles and the Dow Theory there was a common element in that. I discovered that every primary trend change, be it bullish or bearish, coincided. There was actually, he gave dates. William Peter Hamilton, I think it was, gave dates in his book, and I saw that. I'm like, oh my God, that's 4-year cycle tops and bottoms. And so I saw how the two theories meshed, and the rest is history. From there, I was able to make some calls. I had an article published in 2000 or 2001. It's a technical analysis of Stocks and Commodities magazine, calling the top and the decline. I said that we would go down below a certain level, and we exceeded that level by 200 points. So my target was met. and the rest was history. And from there, Cycles News and Views began.
Is there anybody you really admire or influenced you to become involved in the financial markets?
Yeah, I think the guys that I mentioned, Bob Prechter, Peter Eliades, and Richard Russell, all three, I think were huge. Bob Prechter, I've actually physically met at investor conference in New Orleans early on. He kind of took me under his wing. Super guy. And so is Peter. I'm not taking anything away from any of them. They're all were very complimentary. Peter Eliades, to tell the story about Peter Eliades, I sent him an article, the article that was published. Actually, I don't remember if it was published yet, but I sent the work. I just did the work. And I left out one. The Cycles work, backing up, the Cycles work I discovered through Walter Bressert's work, and took a course from Walter Bressert. It took about a year to get through that correspondence course, hands-on with Walter Bressert. He was a real pioneer in the Cycles world, and at the time there was an institute. It was called the Study for the Foundation of Cycles. I think they were headquartered in Chicago at the time. And Bressert was on the board. I think Prechter was on the board for a while, and Peter was involved with that as well. Well, anyway, after taking that course, that's where I got involved with the cycle stuff. So I was able to use all of that material, and I, like I said, identified it. It worked like a champ. Identified the top. It was published in Stocks Commodities Magazine. Well, anyway, I sent the material to Peter Eliades. Don't remember how, why. Don't remember all the story about it. Sent it to Peter Eliades, and he said that he saw it, and he thought, oh boy, here we go. But he read the article, and he called me. And he was very, very complimentary, and we became friends then. So those guys were like rock stars in my world back in the day, and this was in the mid 80s, late 80s, and early 90s time frame.
Mm-hmm. What's your trading philosophy? What set of principles, beliefs, or experiences drive your decisions?
Well, I use, the same thing I just said, the Cycles in Dow Theory, and I tend to err on the side of conservatism. I'm not a big risk taker. That has its pros and its cons. Sometimes you can be too conservative or too cautious, but then sometimes not. So, everything cuts two ways. But I believe in the theories that I have. They work, and the one issue, I guess, or the one, I say issue, I think all the old historians, old school technicians have paid this price, is that it seems like that anybody who's known the most about the market has been more cautious, and being in this bubble environment, that's been somewhat costly, because nobody that I know imagined that we would see this thing blown up into the bubble that it has been blown up into. And so in that respect, I think many of the old school technicians have underestimated, the magnitude that the bubble could be blown into, but it is a disastrous bubble.
How important is it to have an investment philosophy?
Well, I think you have to have a proven discipline that works, and you have to stick to it, because I think one of the problems that people get into is that if they skip around from discipline to discipline to discipline to discipline, if you abandon something, let's say you have something that works, just as an example, that is pretty successful 70% of the time. Well, that's probably a winning strategy. But if you abandon it whenever you hit a bad streak at 30% of the time, you go on to the next strategy, and you keep looking. I think that's a recipe for disaster, rather than make yourself an expert and understand a given philosophy. And for me, that's cycles and statistical analysis, because, like I said, once you understand the cycles, it's basically just trend quantification, and so you can wrap statistics around that and develop expectations. And so it is a statistic, and cycles contract, they expand, but on balance, there are averages, there are norms, and I think that's where the answer lies.
We'll have more with Tim Wood right after this.
Do you want to make money by copying the same trades a professional is taking? Well, now you can. Since 1997, Chris Vermeulen has focused on building technology to help himself become more profitable. He now shares his swing trading and passive investing signal with others just like you. Let these technically proven strategies protect your assets while profiting from the biggest trends, no matter if the market is rising or falling. Visit www.thetechnicaltraders.com to learn more.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, how did you get, I don't want to use the term nickname, but it is kind of, because we use it all the time, the term Cyclesman, Tim Cyclesman Wood. Where did that come from?
Well, there was a guy at the time, when I published the article in Stocks and Commodities magazine, you got to go back to the year 2000, 2001. The internet was new. I remember in my first memory of the internet was 96, 97. And I mean, it was kind of a taboo thing. There wasn't a lot of stuff on the internet. And anyway, I needed a name, and there was a guy on Fox News at the time, Fox Business News, or maybe it was CNBC. I don't even know. But he called himself the Chart Man. And I remember I'd see those things from him, and so I literally just pulled it out of the air, Cycles Man. And it just kind of ran with it and had that name ever since.
What's your favorite type of analysis or indicator you find helps you time your trades or investments?
The cycles analysis, definitely the cycles analysis, and some of the proprietary indicators that I've developed over time. I mean, you have, like I said, you have a statistical window where you're looking for a low or a high or whatever the case may be, and then so you have that target, if you will, and then you have indicators that you wrap around price to help you zero in on when that actual cycle of whatever degree has topped or bottomed. And so, that's it, cycles and the indicators that I use.
What's something you wish you would have known before you started trading and investing?
I wish, that's a tough question. I would say the foresight to have imagined, I go back to this bubble that we're in, that it could have been blown into the bubble that it has. I mean, that's just unimaginable when you look back. I mean, this is something they've been fighting literally for 20 years, and done a magnificent job holding things together. But, and to elaborate on that just a minute so someone understands what I'm saying, when you look at, volume characteristics of the market, job participation, and other economic measures, everything, the real economy, and for people who are old enough to really remember it, I think they'll agree with this, but it sort of all peaked with the dot-com bubble. And then as we rolled over into the '02 low, we saw, the market and the economy was trying to deflate. It was trying to breathe. I mean, it had been on a tremendous run. We'd run up into the, like I said, with the dot-com era and the telecom was on fire then. I was working in the telecom business, and the economy had really moved into a top at that time. But then coming out of the '02 low, where it started was, that's when I think the Fed really stepped into the market and started taking a more hands-on approach, trying to hold things, bridge the gap, as they say. And what they did was, they created, if you think back, coming out of the '02 low, they pushed that advance into the '07 top. That was the longest advancing 4-year cycle in history. And what happened as a result of that? They created the worst financial crisis since the Great Depression. Not my words, Google it. That's what they called it, the decline into the '09 low. And that was a direct result of, the market was trying to top it, and they wouldn't let it breathe. It just needed to breathe. It needed to unravel a little bit. We needed to skip along the bottom and, flush things out and, let it correct. Well, that was never really allowed to happen, and then the market was pushed into that bubble top at that time, and it created, like I said, the backlash was the decline into the '09 low. Well, then coming out of that low, what has happened? What did they do? More of the same on steroids, as they say. We push up into the 2020 top, and then we start to try to unravel again, and then here we go with all the stimulus, and so not underestimating the power of the Fed and their ability to push this into the largest bubble ever, I think has cost a lot of technicians in the sense that they just simply, it was unimaginable that we would be in this position. Now, that does not change the fact that I believe that we're in, as a matter of fact, I'm convinced without a shadow of a doubt, we sit at the top of the biggest bubble, financial bubble in history. And it has to be dealt with. It will be dealt with. It has to unwind. And it will. I think the question is, how well can they continue to hold it? And then the consequences, who knows? But I think we face a tremendous unwinding with this bubble. Absolutely.
Mm-hmm. What's the best advice you ever received?
Oh, from a trading perspective, I don't really, nothing comes to mind other than yeah, absolutely. Yes, I do. One thing comes to mind that Richard Russell told me, and he said, it was about your discipline and perseverance. Stick to your discipline and the perseverance.
What's the best call you ever made that other people thought wasn't the right call, or they made fun of you or denigrated it in some way?
Actually, I have several of those. The top in 2000, I didn't, anytime you stick yourself out in the public, you're subject to criticism. But I remember making the call in 2000 saying we was going to go below the 98 4-year cycle low. And I think that was right at a 40% decline. I don't remember the numbers now. But 39, 40%, whatever on the Dow. And I remember at the time, people, when the article came out, and it was, like I said, the internet was young, and people, they threw rocks at me and thought I was crazy. But it happened. And then that, like I said, that kicked off Cycles News and Views. So the next article was, or the next great call, I don't know which one was better, but, when as the advance into the 07 top took form, I kept saying, it's stretched, it's a bubble. They're pushing, it's a 4-year top. And I didn't have indicator, I didn't have a cell signal. I remember to the day, I remember where I was standing getting phone calls from people asking me in August of 07, is this it? Is it top? And I'm like, no, we need one more push because the structure wasn't right. And we declined into, the summer there, and then made one more push up late summer, and then made one more push up into October, and then boom, it clicked. It had the Dow Theory primary bearish trend change, the cyclical structure fell in place, and I had said then that we would go below the 2002 low, and we did. So that was a great call. And then another one was, and this call was made on the air, on a talk show, and on my own website, in some podcasts, the week after the tippy top, the following week, I saw what I needed to see and made the call in oil. Everybody was talking about peak oil. And I said, no, this thing is, and I had statistics that said we would go back below the previous 3-year cycle low in the CRB, and that which meant we would just see a collapse. And that happened. So that was an excellent call. So there's a number of them. And housing, I got the housing call right in 2000. I remember talking to a builder. We lived in the neighborhood. We just moved, and the builder had come in, and he was kind of a macho, arrogant guy. And I remember in 2006, I'd already seen the signs. Late 2005, early 2006, the signs that housing had peaked. I remember sitting in a board meeting with him and trying to, kind of warn him about it, talk to him about it. And he's like, he wanted to be a smart ass. And he said, well, what do you know about housing? And I said, I don't know anything about housing other than I can read a chart. And I told him what I saw coming. And of course he thought I was an idiot. And, they ended up abandoning the neighborhood as a builder a few years later. So that was actually a pretty good call. Made me feel good.
Tim, you used to do a lot of financial television shows, and all of a sudden that dried up. Is that because, as we heard in that famous movie, you can't handle the truth?
I think there was a lot of that. I don't know what shut that down. Peter Leides, Robert Prechter, a lot of us guys, I think a lot of that is just also a function of the bubble environment. I don't know all the moving parts. You make great calls. It's a thankless business. You make fantastic calls like those over the years, and then you get into an environment to where the market, I think it's a number of things. There's so many so-called experts out there now in the, on the internet, and the internet's matured, people making YouTubes, and everybody can put stuff out for free, and, as a rule, you get what you pay for. And so I think that's probably a factor. Another factor is when you sit and you warn from, a long-term historical perspective, and you talk about the bubble that it's been and the bubble that it is, and how crazy the environment is, people tend to dismiss that over time. They think, oh, well, it becomes the new norm to see this bubble environment. It's normal for, commodity prices to be where they are. It's normal for housing prices to be where they're back to. It's normal to see the market. And in reality, that's not normal. It's an extreme. But people don't recognize the extreme because we've been in this environment for so long. And so I think it's also a function of falling out of favor because people don't understand. And I think that reckoning will come where people will come to understand. And then, of course, I know what they'll say. Well, a clock is right twice a day, whatever. But, I think it's a number of those things. But I think primarily, if I had to put it, and I'm guessing, that I would say that between the maturity of the internet and so many people out there putting out stuff, it's hard for people to find what's valid and what's not. They kind of, when you're looking for truth, looking for analysis, how do you know what to pick from, or how do you really know? And then the other thing, like I said, when you talk about the crazy environment that we're in, and people don't see it, they can't see it, then after a while it falls on deaf ears. But on that note, let me give you an example of the magnitude of this bubble, and I'm saying this from memory because I don't have the math in front of me. But everybody that's market people, I say everybody, most market people are familiar with the South Sea bubble, and I did some math. It's probably been close to a year ago now. But I was looking at the size and scope of the South Sea bubble, and what it was the South Sea bubble was a debt expansion scheme. It was a partnership basically between private industry and England to the English government for exclusive trading rights in the South Seas. They were going to basically monetize their debt, take on their debt, so that England could continue to expand the debt. It's all about expanding the debt, like Richard Russell used to say, inflate or die. And so they did that, and I saw an estimate. I think it was between 30 and 50 million pounds, I believe, was the size of the debt at that time. So to put that in perspective, I had some 1904 encyclopedias, and I looked up the South Sea bubble. Sure enough, it was in there, and as of 1904 dollars, it was estimated to have been, and I don't remember the numbers, but it was like $150 million or something like that, whatever the case was. So that's irrelevant anyway, whatever the number was. I just don't remember on the fly. But then I found a conversion, just Googled, okay, $1904 equals whatever, and found what the dollar equivalents would be worth today. And it was like, the point being is that the bubble environment we're in today, based on the debt, it's an asset bubble, but it's been debt driven. The debt bubble today, looking at the U.S. government's debt, that's on the balance sheet. You can go to the Fed site, Google the number, and it's like, I don't know, right at $30 trillion. That was it was over 6,000 times that of the South Sea bubble. And so that's what I'm saying. When you're in an extreme environment for an extended period of time, you don't even recognize the extremity of the environment that you're in because it's normal. And that's the that's what we face. And this has to be unwound and dealt with. And that's what the Fed has been fighting and trying to hold. And I understand that. And, on the one hand, you're trying to prevent it, but at the same time, the prevention is making it even worse. But as they say, if you can kick that can down the road and let it happen later, I guess that's what you do. And so I get it. But anyway, I don't remember the question or now, but it's the bubble is enormous.
Now, for young traders, many of them have never experienced a recession. There hasn't been an official one since 2008. If things go bad, do you think they would panic? Would they look at the past, see what you should do? Or do they really believe the Fed has your back? Nothing bad can go wrong.
I think people have been trained that the Fed has your back so much since, like I said, since 2002. This has been going on for 20 years, and I think that's ingrained in people. And I guess my advice to younger people is, it may sound taboo, it may sound old school, it may sound whatever, square, as they used to say in the 70s. But my thinking is a grounding. It's kind of like martial arts. I took traditional martial arts, and it was like basics. It's boring. Basics, more basics. But you did it, and all of a sudden you realize that you have built a foundation that is basically muscle memory, and you're like, wow, where did this come from? You've programmed your brain, you've built a foundation. And so that's the way I see technical analysis and historical technical analysis, more importantly. That's one thing that Peter Alighty said to me. He said, when he read that article, he said, somebody will send me, I'm talking, back into my article in 2001. He said, who goes back? Most people go back, if they go back 20 years, they think they've done some analysis. And, this analysis went back to 1896, the inception of the Dow Jones Industrial Average. And so that's what I'm saying. When you have a foundation in history and some statistical, in my case, statistical basis, statistical analysis wrapped around that history, then you can look at a situation like this and recognize it for what it's for. But if you don't have that perspective, there's no way to see it.
One of the people I've interviewed, Eric Haddock from InsideTrackTrading.com, he said history doesn't repeat, but it often rhymes.
I would agree with that.
Yeah.
Absolutely. I agree with that.
So you have similar circumstances, but the outcome isn't exactly the same, but roughly it will be. So if we're doing an echo of history, what do you think's happening right now?
Well, I think we're dealing with the unwinding or the eventual unwinding. It's a process. And like I said, it's not conspiracy. It's not an excuse. It's a fact. Anyone can look at this at the market fairly and see that there is why do they raise interest rates? Why do they lower interest rates? Why do it is a deliberate attempt to hold this thing. And I get that. If you or I were in their shoes, we'd be doing the same thing, because we know the inevitable. And so the thing is that there's more of a hands-on approach to the market, and so there's been more outside influences, which is in turn, like I said, it's good and it's bad. It's good in that it's prevented this. It's bad in the sense it's made it worse. And so I lost my train of thought on what was your question? I was going somewhere with that. What was your question?
Well, it's just the young, we call them youngsters because they're all old guys, but they haven't experienced this for 12 years. We haven't had a recession, official
exactly.
one.
And so my point was they don't have that perspective. I lost my train of thought for a second, but yes, that's exactly right.
Do you have any advice for them? Is there reading they can do, some research that, hey, history has a tendency to repeat itself?
Everybody's got to find their own niche, I think. But, cycles analysis, Walter Bressert, his material is no longer available. He was much older than me, and and he's no longer, Mr. Bressert's dead. Richard Russell, he wrote one or two little, basic books on Dow Theory, and I guess that's a start, but, I didn't really learn Dow Theory until I got those original writings. Unfortunately, it's kind of like finding a traditional martial arts school. To find this original writings, this old traditional technical analysis is kind of hard. But, I think that's the direction people need to go. And I'm not talking about a book where you learn what a head and shoulders pattern is and a rising wedge and all this kind of thing. I'm saying some real technical analysis where, that you can wrap some statistics and history around. So, and that's hard to find these days because it's just kind of a lost art.
Tim, before we go, is there any topic or financial or business practice that you're really passionate about?
Well, I love the markets. I absolutely love the markets, as frustrating as they can be. It's the analysis is, that's what I do. It's who I am. It's who I've become. And I love the markets. But, at the same time, when you see something like the bubble environment that we're in and knowing that we're in that environment and seeing it just stretch and stretch and stretch, that can also be frustrating. But no, other than that, that's about it.
Tim, thank you so much for being on the Technical Traders podcast.
Thank you very much.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He was speaking to us from Gulf Shores, Alabama. I'm Jim Goddard.
Thanks for joining us this week on the Technical Traders Podcast. If you found value in our show, subscribe and give us a rating or share it with a friend. That would be greatly appreciated as well. TheTechnicalTraders.com, your source for technically proven strategies to make more money with less risk so you can take your trading to the next level. Comments made on the Technical Traders Podcast are an expression of opinion only and should not be construed as investment advice or recommendations to buy or sell any financial instrument. This information is for general information and educational purposes only. Guests on the show are not compensated for their participation. To view our full disclaimer, please visit our website at www.thetechnicaltraders.com.